Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boyciano, and today we have Mark McArdle. Good morning, Mark.
Morning.
And who's missing? Where is Kevin? Oh, yeah. He is educating himself today and cannot be here. Unfortunately, uh, I thought about just ignoring it and seeing if you guys could guess that he was not here and where he might be, but went with this instead. So, Mark, thank you for being here with me. I really appreciate it. Now, everyone understand that Mark did his patriotic duty today and gave blood. So, Mark, I was asking you, did you actually have to leave your house or did they come to you?
No, you have to go to a blood play. Yeah, like I went to the American Red Cross and I got a newbie and they took too much blood out. So there's a 50% chance I might pass out during this. So
Yeah, when you warned me of this, I tried to think of some, Mark is dead jokes, but let's keep it going, but nothing came to mind. I don't know why. So, Mark had a really valuable pointer though. If you are at the Red Cross and you're giving blood, apparently the newbies wear red shirts. Is that what you were saying?
that's
Yeah.
correct. I,
So look
I
out
got a
for
newbie.
that. Okay, so it's been yet another interesting week in mortgage land. So rates are a little better. They seem to have stabilized a little bit. This morning, it looked like the 10-year was bouncing around between 4.411, 412. I think I might have seen it go down to 410, but anyway, better. At least it's so tomorrow we have CPI, mortgage apps, 10-year auction. Thursday, we have housing starts, jobless claims, and a 30-year auction. And Friday, last but certainly not least, we have PCE and GDP Q4 second reading and JOLTS. So typically these would be big market movers. Things like, CPI and PCE, market really pays attention to them. However, we're seeing the market shrug off some of these reports because there's this other little thing going on. What was that again? Oh, yeah, Epic Fury. That's right. So it was
Great
a
name.
barn burner last week. I mean, I don't know who else had to double up on their meds or drink more, but rates were all over well, they were really just going up. Actually, they weren't really all over the place. But as was forecasted, they tend to go up when you have a conflict like this, and then they stabilize. And because oil has been, oh, good God. Don't do that, Mark. Jeez Louise. Oh my God. That scared the shit out of me. Did he really just
No, I'm fine.
oh
Thumbs
my
up. I'm
God.
good.
Okay, I don't care what you drop again. Do not disappear off the screen. Oh my God. Did you at least drink some orange juice after you gave blood?
Yes, and I got water and tea here, so I should be
Water and
good.
tea is not what they give you to revitalize yourself after or
I
giving
did have a
blood.
juice box.
Oh my God, that is so, jeez, Louise. Yeah. The last time I gave blood voluntarily, I was in college and they apparently have little tiny veins and they stick the needle in and they just like dig around. I
It's
almost passed
horrible.
out. That was the end for
Yeah.
me. So anyway, all right, let's go back to what's going on out there. Oil. Oil, that's really been the deal. So we hit almost $120 a barrel yesterday. That was up from, I think we were like 65 bucks a barrel, 68 bucks a barrel or something like that before this started. We are now down to, or last time I checked this morning, God knows what could have happened since then. We're below 90, like at 86 bucks a barrel, but that's still $20 more a barrel than before Epic Fury. So the Strait of Hormuz, ships are passing through. Can you imagine? I was thinking about this morning.
It's
You're
very
one of
narrow.
the people, it's very narrow. I mean, how many of us knew exactly where the Strait of Hormuz was before all this? And now we know how narrow it is. And the thought of being one of the people on one of those tankers that is like, all right, let's go. Let's just give it a shot, see what happens, right? Okay. So, hey, Greg is saying that we're now at $77 a barrel. Okay, why yeah. So, and Michael is telling us 20 miles. Thanks, guys. Appreciate that. I love details like that. I don't know why it does it for me. So they're passing through, and then President Trump mentioned that the war with Iran was very complete, pretty much. So we'll see. We'll see. But what we're hoping for here is stability. And I that's all we can hope for, I think, right? Well, that and the G7 mentioned that they may or may not release 300 to 400 million barrels of oil from the global reserves if needed. So we'll see. Yeah. Oh, so Jill is saying that she remembers the mid 1970s and the war with Iraq. So they knew how narrow that Strait of Hormuz was. Great. Wait, 1970s. That wasn't 70s, was it? Anyway, all right. I'm digressing. Bottom line, Mark, have you ever heard me sing that little song? If you see a rate you like, lock it in.
Oh, yeah.
Yeah, right?
That's a good song,
Okay.
yeah.
I'm just going to tell you that's bit me in the tail a couple of times in the last week and a half. Because, they keep saying, oh, you have to have a strike rate with all of your clients right now. You have them all set up for their refinances. They have a rate that you've agreed you're going to lock when you see it. Unfortunately, the rate that I had agreed on with my clients, a lot of them, was about an eighth lower than where we landed on the bottom before it all went to AT double toothpick. So anyway, I have a couple of people who are very happy, and then the rest were just waiting patiently and hoping for the best. So, what are your thoughts on all that?
It's chaos, right? And there's like even if the war does end soon, like the inflationary pressure of the war will continue. I mean, I think we spend $1 billion a day on that, so that also could affect rates down the road. So
Yeah, I mean, those inflation, that's the reason this is the issue. It's funny because I'd seen someone pose the question, why aren't rates falling? And in a word, it's inflation and fears around what the cost of the war and oil prices are going to do. So it is also going to be interesting to see what's happening because we're seeing like existing home sales are better. So they were up in February 1.7% over month, and it was expected that they were going to be down a 0.5%. And the annualized pace is on track for 4.09 million units this year. So January was revised better. I also thought it was interesting too, because those existing home sales and Realtor.com inventory numbers were very different. So inventory was said to be at 1.29 million units, which is up a little bit, but still, way down from normal. It's only a 3.8 month supply versus the 4.6 we're supposed to be expecting. Realtor.com was saying we had 915,000 units, same as January, but we're up year over year, but still down 17% from pre-pandemic. So again, our inventory levels are still lower than they have been historically. Our population is higher. And so we'll see how it all rolls out. But in my area, people are having major multiple offers. And I'm not talking like, oh, I got two offers. I mean, there were 15 offers and we didn't write because we don't want to be in that mix. You know what I mean? That kind of thing. So, and it's not just one or two. I'm hearing this over and over again. So I'm curious what other people in other parts of the country are seeing and experiencing with their clients. And what do you think?
there was a great chart in Housing Wire that showed where things were post pandemic on supply, and at least in the South, in states like Texas, it's like now better than it was before the pandemic. Some states like Illinois, for some reason, and some of the Northeast are not as good, but California somewhere in the middle. But yeah.
Yeah, I always like it when California's not even on a list. Like, I don't want to be the high, I don't want to be the low. I just like to be somewhere, where it's sort of stable and not terrible. And, and we've talked about this before, but when we're talking about affordability, and they always talk about how unaffordable California is and it's so expensive, et cetera. But when you look at delinquency rates, we pay the bills here. Like people are
Yeah.
paying their mortgage. It's
And another key thing is, you have a reasonable foreclosure timeline. I mean, I was talking about this with somebody else. Like, one of the weirdest things is how the divergence between some states. In Louisiana, Nevada, it can take, let's see, 3,000 days to foreclose, while the shortest states, which include New Hampshire and Texas, you can foreclose in less than 6 months.
whoa,
So
whoa,
that
whoa.
gap, 3,000 days is it's
Where
in
is
the
that?
Adam report. So that's like 6, 7 years it takes to foreclose from when you start to when you end. I mean, there's
What
lots of
state is
stats.
that in?
The worst states were Louisiana, Nevada, New York, New Jersey, Hawaii. And the best states were, I mean, the shortest states were New Hampshire, West Virginia, Texas, Virginia, and Wyoming. And California, like you said, is right in the middle. But it's usually judicial states,
Yep.
and that slows up the process greatly. And for servicers who have to advance payments, Can
Yes.
you imagine advancing payment for years,
Oh
principal and interest,
God.
until the loan is fully resolved? That's insane.
Oh my
And
God.
for
That is,
Ginny, and especially Ginny, because you
yep.
have to go all the way to the end.
Yeah. That was a big issue during the CARES Act too.
They were
Uh,
worried during COVID that it would bust all the non-banks. Yep.
right,
But then
right.
there was a refi boom.
Yeah, right. Okay, so first-time buyers are 34% of the market right now versus 31% a year ago. So that's promising. And also, Mark, we had talked about the fact that there were 6 surveys done on the average age of the first-time homebuyer, and the one that everybody talked about, including us, just to be clear, was the one that said that the average age of a first-time homebuyer is 40 years old. And it turns out that the other five, it was more in the 34, 35 year
The same
range
as it's
or
always
so.
been. Yeah.
Yeah, so, again, it's okay. So investors, flat, it's 16% of the market. Cash buyers, 31% versus 32 last year. Sold about above list is still 14% versus but 20 it was 21% last year. And then days on the market has gone from 42 to 47%, or for not percent, days. That'd be days on the market. Mark.
Yes, days on the market. What are you?
Got it.
Was there a question there?
No, I'm just looking for, signs of life. You got to give me some sort of evidence. You can't just sit there. Stop it. Jeez Louise. Okay, so ADP weekly employment, they started doing their weekly employment analysis during the government shutdown. So now we don't just have to wait for it once a month, we get it every single week. So currently, for the week ending February 21st, they're at 15,500 jobs per week added. That would translate to about 60,000, 70,000 jobs for March. But we got BLS's job report on Friday, last Friday. Did you see it?
It went down.
Yeah, not by a little. And just a little traipse down memory lane a month ago, or whenever they released January's, they said that we'd had 130,000 jobs created,
They pushed that down too.
which everyone thought was complete and total malarkey. Let's go with malarkey. Uh, and sure enough, it was. So we lost 92,000 jobs last month after they had expected that we'd have 55 to 60,000 jobs. And then the revisions for December and January were down another 69,000 jobs. So, we got the unemployment rate at 4.4, really close to ticking down to 4.3. So this is not new news. We know that the jobs market is funky out there. And so when we get a jobs report that says we have 130,000 jobs created out of nowhere in the face of every other report, saying something different, it's frustrating because they move the markets. Anyway, so with all that, in other charming positive news, NFIB, the Small Business Owners Optimism Index, shocker, they were less optimistic. We're down to 98.8, it's the lowest in 5 months, and 4-point drop on plans to hire. So again, back to jobs, not great. So before the war, we were at the best affordability in 4 years. With that being said, I would think because rates have not, I mean, yes, they went up from where, the lows that we had, but they're not, like they didn't go to 7, thank God. So it'll be interesting to see how it shakes out in the next couple weeks, but hopefully we're just going to cross our fingers. Any thoughts on that, Mark?
Right. Yeah, there's so many things that drive into that. Yeah. So, I mean, the old advice is like, if you can afford the house and, it's where you want to move, and you got the right, go for it, right? The house is forever, so not for just now. You can
Well,
refi
and
down the road.
it used to be, they always, the number we'd used for years and years and years was, oh, people move every 5 to 7 years. And that certainly
Not
has
anymore. It's up to
shifted.
12, I read somewhere.
Yeah, me too. So people are staying put, and it's not just, I don't necessarily know that it's just rates. I,
It's a little bit of both. I mean, I think people are moving less, but I think it's also, it is hard to move when you got that 3.5% rate.
when was the last time you moved, Mark?
22 years ago. So
When was the last time I moved, Mark?
longer, I bet.
23 years ago.
Oh,
Yeah,
you beat me by a year.
not much, but anyway. So yeah, it is definitely shifted. So I had this little note on my list of notes for a while saying, what happened to that Freddie Mac second that was such a big talking point for a while there? So I did a little poking around and it seems to have just fizzled into nothing. So no Freddie seconds, I take it.
New Res was actually a pilot for them, so we did do New, but I think people thought that was outside the scope of Fannie and Freddie, and so when the election occurred, they backed off of that pretty quickly.
Oh, okay. I didn't catch that correlation between that. I just thought it was odd because it just seemed like such a strange direction for one of the GSEs to go for me. I'm like, that's being done. Why are they trying to
Right.
step in and do something that's being done? What is the point? But
That's
God,
a
there was
big question with the GSEs is like what should be where they play and what is beyond their scope and should they be doing second homes and investment properties and all the things that they do. And there's a lot of debate about that in DC.
well, I mean, I think that the second homes and the fact, why do they lump second homes and investment properties together? In my
Yeah, they're
mind,
two
they're
separate
two different
things.
animals
Yeah, they are.
because people need rental properties, right?
Yep.
And you in the institutional lenders, I mean, let's just keep it real. They're not the best landlords. The mom and pops are the best landlords. So
And then the majority of investment properties are smaller. It's like something like 90% are less than 10. Yeah.
exactly. And so, and that, you and I were talking briefly about the institutional investor ban, and we've just discussed it quite a bit on here because, we've asked the questions too of economists, et cetera, like how much of an impact does that have? And right, the answer that we've received was in the areas where it's an issue, it can have a good impact on the market, but that isn't most of the country. And so it won't have much of an impact overall. So anyway, yeah. I also saw this. I don't know if you saw this. Did you see that PHH Mortgage is changing their name to Onity?
That already happened. That happened last year, yeah.
They're sending notices right now. It already happened. They said it's about to
Yep.
happen.
Nope,
Okay,
it's already happened.
I'm gonna take your word for it because you're smarter, and I won't read in full my note about this, but it may have been three initials asking a question. So why Onity? I wonder. I see these name changes. I'm like, why? What are we
You
doing?
do wonder, like when, Truist was, they all change their names. They lose any like association in history. I mean, I still
Or
remember Harris
logic?
Bank when I was a kid. They used to give you a
Yeah,
line if you opened a bank account, and yeah,
yeah. Well, I just
they're
think
long gone.
everyone keeps talking about the increasing prices and how it's so much more expensive to manufacture a loan and servicing costs and all this stuff. And I'm like, um, how much does it cost? Like when the Department of Real Estate became the Bureau of Real Estate in California, I'm like, how much did it cost to change the
Change all of
letterhead,
that.
the business cards, the website? What are so frustrating. Anyway, all right, moving right along. So let's talk about the fact that the three bureaus, credit bureaus that is, have decided to reduce their Vantage score price for the mortgage industry from $4 a pull to 99 cents a pull. So, my understanding is we can now buy a Vantage score at the 99-cent store mark. You can also get that for no cost if you have a score choice bundle. I don't know what the hell that is, but I thought I'd throw that out there if somebody else heard it and wanted to investigate for themselves that maybe they can get it for free if they have that. But uh, considering what percentage of the mortgage industry is using Vantage Score right now, is that going to help us?
You know, Advantage, as you know, is owned by the bureaus, so they'll have this inherent competitive advantage for pricing. And it is interesting if they are able to, ever win the credit score war. What will happen to prices then? They're the only one left. Yeah.
Oh my gosh.
Yeah, but
So,
someone said in the comments, and it's true, it doesn't work with DU and LP. Pulte announced that they would accept Vantage Score immediately. Was that last summer?
yep.
And to this day, you still can't submit a Vantage Score, except we did it on a special pilot project. But so it's still they have to change the grids. They have an LLPA grid. A Vantage Score is not the same as a FICO. They don't quite fit. So you need to figure all that out. And as of now, they haven't done it yet.
So you were doing this, yes? Is that what you just
We
said?
had a pilot project where we used VantageScore for a pool of loans for one of the GSEs, which shall remain nameless. But yeah,
And so a lot of the talk that I've heard is that the issue with a potential Vantage score is that the secondary market doesn't understand how those loans perform. So
yeah.
if that is the case, then how did you guys reconcile that and how did it go for you?
Well, I mean, remember when you're delivering to a GSE, the GSEs hold the ultimate risk, right? So they'll deal with the investors and the marketing. Often they probably provide both to the secondary market. So you might pull advantage, but then the GSE on the back end will add the FICO. So the
Oh,
investor who buys the MBS can say, oh well, that because it tend at least most people I know say the Vantage score will be higher. It floats up, so so a 700 Vantage will be a 660 FICO or whatever. And so having both is as long as they have the one number they know, the investors are good.
I mean, but what is to keep, I mean, I would imagine that it occasionally happens where they go to pull the FICO score and it's like completely different than they were hoping for. And because I have seen FICO be lower than Vantage, not a lot, but and I don't see this a lot, obviously, because we're not pulling the Vantage
Vantage score,
typically.
yeah.
But anyway. I just find it really interesting. Like, how are they dealing with this? And you ran a pilot for them, so does that mean it didn't work out and it's
No,
over?
no, I mean I think they're still trying to work out the machinery, how this works and how I think you'll see Vantage Score sooner or later accepted in the mortgage market, as one possible alternative. What you want to avoid is the gaming and people picking their score, book base, that because that might have downstream effects that nobody wants when you people start losing, oh, I can't qualify them on this one, or they'll get a low, and then that that
Okay.
that that road goes to chaos.
I find that conversation kind of interesting because I've heard it both ways. So we were told that we had to be careful with this when it came to rapid rescores, right? Where you take somebody's updated information and update their score at the credit bureau level, and then you have a new score to deal with. So I had heard lenders literally say, you cannot do that because that is manipulating the credit scoring system and it's fraud and blah, blah, blah. On the other hand, I've heard that the regulate and actually you can speak to this, that you're supposed to give the borrower the best opportunity to have the best mortgage and the best rate and the best da, 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 that they can have. And so, like if they have an improvement, then why can't anyway? Yeah.
I think you have to. One thing the Bureau will not, the CFPB, someone asked whether, by the way, I retired from the Bureau retired me. It was a preemptive thing where I left the Bureau because things weren't, going so well. But the Bureau used to say you can't, if you used one score to qualify and get them in the door, and then you pull the final score and it's different and there's a price change, that you're going to have to eat that price change. What the Bureau will say is the consumer didn't make that choice, you did to pull which score, and therefore there should be no financial impact on the consumer. So if you got them in the door and said this is going to be your rate and this is what it's going to cost, and then you later go, oh, I was wrong, that's on you.
Okay, I'm just going to call bullshit on that just for a second. Sorry, guys. Because you pull a score in the beginning and it all looks hunky funky dory, right? And then you pull the score at the end, and then they have bought a car, they've jacked up their credit cards, they let something go to collection. We had nothing to do with that. What the
For sure, that's a substantial change. But then the model we're talking about is like, let's say you pulled one score and then you pulled all three, or you pulled a Vantage score and then you pulled a FICO. That's the sort of thing where it's a decision choice. Obviously, if the borrower all of a sudden goes into bankruptcy, everything's off the table. And we're talking about mostly from the loan estimate to the closing disclosure stage, so way down the process.
Okay, well, hopefully the it anyway. You can't be too far down the process with the LE, right? Um so all right. I just think that when we're having the conversations, especially when NBA is talking about, doing a single poll or, credit poll instead of three, and then who do you choose, et cetera, et cetera. It's complicated. It's just complicated.
It is complicated, but I think a lot of people think that the system is ripe for some kind of disruption. Like you got these three bureaus. If you have to buy three of anything and there's no competition or choice, or like that leads to bad outcomes generally. So like I understand what the NBA is trying to do. I totally get your point too, that it's complicated and you have to think about like, if you commit to one company and one score, you have to maybe stick to that for a period of time until you renegotiate with another, in 6 months or whatever. Because I think you do want to introduce some degree of competition in the system so people are looking for who gives me the best score, the most accurate report at the best price. That doesn't happen now. You pull all three and, you pick the middle.
Right. Right. Well, and again, we're so focused on $100 fee when you've got so many other fees that are off the charts and so expensive, and
An
nobody
appraisal
wants to talk
six,
about
seven
that.
hundred dollars, right? So yeah.
Oh, 750 to 1,000 easy for just a simple, it depends on where you are, obviously.
Yeah.
So, but just because you're somewhere that might have less income, less value, all that doesn't mean your appraisal is going to be cheaper, I have found.
Nope.
So, again, that's the Wild West because they can charge whatever the heck they want, whenever they want, however they want. So, sorry, appraisal guys, especially Michael, if you're listening. Sorry. Anyway, I'm gonna get put in timeout if I'm not careful. So, um,
Yeah.
okay.
Wait till you get your delay on your next appraisal. Oh, sorry,
Oh
Audrey,
my
I can't
God. Well,
deliver
okay.
that.
So this guy, this AMC, I love him so much. Axis appraisal. They're just great, and he's great. So, but he and I have gotten into kind of arguments, maybe real arguments about, pricing of appraisals, et cetera, et cetera. So, anyway,
I've always supported the GSEs using appraisal waivers in some circumstances. They know based on that property and how recently it turned over and the AVM about whether they really need an appraisal for that property or not. That can save meaningful dollars. I mean, it's not going to be
it's
every
huge.
property, but yeah.
It's huge. I have another appraisal friend who's sat on Senate, subcommittees, et cetera, about appraisals. And he and I have gotten actual arguments about this because I always say if you own the house, you just want to refinance. You don't really care. It doesn't matter as long as you qualify for the refinance and that you're not getting a low appraisal so that your pricing is worse, right? So,
In places like DC and San Francisco, so much of the value is the land. I mean, my
big
sister's
time.
house is going to appraise at, $600,000, even if there was a shack on top of it. Someone's going to rip down her house anyway. So,
Where's your sister's house?
it's in Kensington. It's a well-to-do suburb of DC on the other side. So, not where I,
Oh, 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 oh. We have a Kensington here. It's very lovely up in the
yeah.
hills. I wouldn't want to be there in a fire, but anyway, it is beautiful. Okay, so we have a couple comments. So Deborah had said that second homes and investments were lumped into the non-QM bucket, lack of understanding of non-traditional conventional products. I would agree, and she's smart, so she would know. She also said the Aqua meant new company, but
Yeah,
then
if you reverse it.
oh my God, right? I mean, I do, like if you're dyslexic, that makes a lot of sense. Too bad Kevin isn't here. He would really appreciate that. Okay. And then Joni had said they changed their name to save money in taxes, even if it cost $1 million in stationery. And I'm like, I mean, there's a
Well,
lot
in,
going on
in
behind.
DC, we're renaming everything Trump. Think how much that costs because they have to get the crane up there and throw up Trump on top of it.
Is that right?
The
Oh,
Trump Kennedy Center, there's like two different, the Trump Institute for Peace, there's been two different changes. He also said he would only put money into Dulles if they changed Dulles Airport to Trump Airport. So,
okay. I I don't know what to say. Um, okay, here, I'm gonna talk about this. Ready? I saw a poster at the theater. I thought that Steven Spielberg was finally making a movie about the mortgage industry because the movie is called Disclosure Day. I mean, it shouldn't be about us, right? It's coming June 12th, 2026. So I had to Google it to find out what it was really about because I imagining Steven Spielberg isn't taking that much of a dive. And apparently it's a global panic when there's proof that alien life exists. So you'll probably love it, Mark. That's a movie you'd go to, right?
right up my alley. Yep.
Yeah, exactly. Me, not so much. Except I
Better
like
than a movie on Trid.
uh oh my gosh. Um, okay. Oh my God. Okay, this has to be. This has to be Guy. Mark, now that you are not with the man anymore, please answer this. Should LLPAs be risk-based or should they be used for social engineering? I don't even have to look at the name to know who that question came from.
I mean, the point of LLPA, because there's a government, there's this backing, is it should be risk-based, of course. And when you start to get to the cross-subsidization, it can get complicated. I mean, there is a mission-driven purpose to the charters of the GSEs, but they have to be judicious in how they apply that. So,
Well, I think it's fair to say that no one has been terribly judicious on how they apply that on either
well,
side.
as long as they're in full government control, I mean, they'll be used as tools. You just saw it. Like, I want rates to be lower. I'm going to make them buy MBS. That's going to be the way it goes for a while now.
Do you think the guys who were deciding to buy MBS and the guys who were planning to start a war were in the same room, or do you think they were in different
Different
on
things, yeah.
different planets? Yeah?
Yeah, different planets.
Okay. Okay. So, Mark, trigger leads are now illegal unless you're a servicer. So, who's
Servicer,
regulating them?
existing bank, or the originator,
So,
or you give consent.
who is regulating it?
So that bill actually modifies FCRA, which is the Fair Credit Reporting Act, which is administered by the CPB, which always used to do exams of the three trade bureaus.
Right?
It's the credit bureaus who have to have controls in place as to who they sell leads to. They're doing an affidavit approach, I've been told, but they're also going to use something on the back end to verify. I don't know how, the mechanics of that, but I think that'll be an easy thing for someone to check. Because it is a consumer law, the AGs, the state AGs, can also enforce that. So they don't even need their own state law. They can enforce the federal trigger lead ban as well. So if there's violations, you could also see states getting involved. But the primary regulator is CFPB, and FTC also has a role with the FCRA as well, the Federal Trade Commission.
So okay, I want to go back to what you said about how they're going to regulate this. They're going to they just have to look at the three bureaus and see what or who or not who they are not selling to.
The primary liability will be against the three bureaus. So if you see them giving out the trigger leads without having the controls, I think that would be a vulnerability for them that could be easily detected. It's going to be harder to detect it on the other end where you're getting the calls.
Oh, that is really good news. I mean, good news. Because it's so much easier than trying to chase down somebody who just, called your client, right?
Right.
Oh, that
Well, we'll
totally
still
makes
need
sense.
people to keep your ears down and like where, find out who is violating it and then find out where they bought their trigger leads. So, I mean, but there are only three of them. So TransUnion, Experian, and Equifax.
Well, and I also, and again, I probably sound like a broken record, but what else is new? The servicers, although they can go after your clients, people hate their servicers. I mean,
I,
they hate them.
I think everybody in the servicing game understand that if you really want this recapture thing to work, you have to deliver top class service. We had Newres just hired a homeowner advocate. And so we understand that if you don't have a good experience with your servicer, you're not going to want to refi with that servicer. So it's
No.
essential to make sure that, every servicer who wants to be in this game, you provide top class service, or you're not going to be able to keep those folks when the rates go down, if they go down, which let's hope they
So
go down.
this is going to come as a humongous shock to you, but that's not happening in most servicers for many servicers. So I just had a client who was sold back to the servicer they had just paid off, and they were so upset because they were treated so badly by the previous servicer. And I had another servicer where a loan was sold, and then they went after the borrower before the EPO was even up. And I mean, people are taking notice of this. The consumers are unhappy. I mentioned last week there is a lawsuit out of Columbus, Ohio, where a homeowner is suing a major lender servicer, saying that the servicer shredded her money orders, pursued foreclosure
I
despite
saw that.
receiving sufficient payments. Did you see that?
Yeah.
Isn't that, I mean, that is nuts. And so for these companies who are so hell-bent on taking our clients from us, you would think that they would hire a homeowner advocate and make sure that they're taking care of people and doing things compliantly. Oh, and by the way, the right way to do something anyway, even if you're not going to have a compliance officer on your tail.
Yeah. I mean, I think eventually, Nothing says that they won't be able to sell it, but when I was refining, I did look for an originator that said they would keep the servicing generally, because I wanted to know what I was getting into. You find a good loan officer like yourself, and you company that you think you want to go with, and then you're sold to some servicer you never heard of. So, I mean, I think people should start thinking about that as they make their decision on the front end.
More
Not that anything,
secrecy.
yeah, they can always sell it, but we do try to keep our servicing. It's why, it's a big thing for us.
It is. I just, yeah, it's funny when I hear servicers, they're so concerned about runoff, right? They don't want people to pay them off, but then they're so worried about retention and whatever that costs. And I'm like, okay, can we all just, anyway. All right. So hopefully we answered all of Guy's questions and he's satisfied. He's not going to call me after the show's over and yell at me. So, um, yeah, that happens, Mark. That really happens.
I
Okay.
get yelled at too.
Do you? Not by me. Well, yeah, that's not true. I have yelled at you when decided you were
That's
cheap
true.
to pay for your 59.99 a year for your Duolingo uh pro subscription, but I'm not upset or bitter still, I think. Okay, so mortgage delinquencies. So you're going to keep seeing the headlines, mortgage delinquencies. They're up. They're up. Oh my God, they're up, right? But yeah, they're up, but they're still at historic lows. And a
This is true.
lot of the rise in delinquencies is still coming, or most of it is coming from FHA and VA.
This is true.
FHA and then VA had a moratorium that was just lifted last year. So, of course, those numbers are higher. So when you're looking at statistics and percentages, et cetera, they do look alarming, but they're overall they're not. Mark?
And something just to keep in mind is FHA made a substantial and dramatic change to their waterfall on October 1st. So every loss mitigation permanent option now has a trial, which will make the delinquencies seem, because it'll take a little bit longer before the delinquency is resolved. And this biggest thing they did is they're stopping churning. So there was a stat in their last report. Nearly 40% of people who got a mod in September of 2025 had two previous mods. So that means this is the third mod. So now they're saying you can have one permanent solution every 24 months. And I think a lot of people think that's a reasonable check to stop sort of the same person coming back again and again and
Yep.
again. And that does mean that there'll be some folks who don't stay, will move through the process. But, we're not doing anyone any favors by constantly putting them in a churn of delinquency. Their credit score is trashed, that, they're just going back into the process again and again and again.
So when they go into one of those modifications, it ruins their credit. It's
Well,
your
when you go
choice.
delinquent, it ruins your credit. So let's think
So
of the
the
world where
modification doesn't change the
the
delinquency
modification
status.
is less impactful than missing a payment and missing two payments, especially, that's a big drop in your credit score. A mod, sometimes can impact your on the margins, but not compared to that missing a payment, which is the biggest thing you can do. It's sort of like a hierarchy. Like obviously, if you pay as agreed every month, you're going to have no impact.
Yep,
If you go delinquent, you're going to have the biggest impact. If you talk to your servicer and get into a solution, you'll have a minor somewhere in between those two.
got it. Okay. So let's talk about the Basel Bank Capital Framework. So if you're a loan officer, do not hang up, okay? Because he is going to explain how this trickles down and impacts us, not just, some blah, blah, blah banking reg crap. So tell us, Mark.
I don't know if I'll be able to, but to promise all your promises, some L's might drop. But this does affect everybody in that right now there's what's widely considered to be a punitive treatment of things like MSRs and warehouse
Whoa,
lines,
whoa,
which
whoa.
have
You got it. Nope. You got it.
mortgage servicing rights,
There
which
you
are
go.
an asset which non-banks and banks can hold. Right now, they're weighted at 250%, which is the same as like junk bonds. So it's a lot of people think that the rating, the way they're weighted under this framework is punitive, and discourages banks from participating in mortgage, and actually creates sort of a friction for people who loan non-banks money, like warehouse lines of credit that we use to make loans. So
Okay, hang
if they
on, hang
got
on,
the
hang on. I got to slow you down there for a minute because even though I know you think you're speaking regular English, I just want to
I'm
make sure
not.
it's
I've
super,
been in
super clear.
TC too
What?
long. I've
I
been in
know,
DC
hey,
too
I
long. It's
know, I
horrible.
know. It's like a bad case of a social disease.
It's
Can't
a
get rid of
bad
it.
disease.
Uh,
Yep.
okay, so if banks buy and hold mortgage-backed securities, then that is counted worse than another asset on their balance sheet, and it makes it harder for them to meet the capital requirements, correct?
That's
Okay,
all correct. And
was
and
that
if you do
clear?
warehouse lines to non-banks, it's also treated very poorly, and therefore there's like it's expensive for the bank to do these things. Like and the idea of this reform is to try to make it less expensive. And I don't know if banks are going to go and do mortgages anymore, but at least they'll be more involved in warehouse lines and other things that might be helpful.
Okay, so that is being proposed.
That is, yes. Mickey Bowman, the Federal and the Federal Reserve, and Scott Bessent, the Treasury Secretary, have all said that this is a priority. We're expecting the rules to come out at the end of the month, the end of March.
So does Mickey have a nickname for you too, or is that
No,
just
no, no. That's what everyone calls her. I'm sure she just calls me that geeky Fed guy with the weird backdrops, but she doesn't
oh
even know who
God.
I am. So,
I just want to tell everyone that Mark and I scrolled through many backdrops. The first one he had up there was making me seasick. So I was either going to have to take a Dramamine, that both of us would be passing out before the hour was over, or don't start. Do not start. Okay, let's talk about the road to housing bill, which
okay.
has been creeping its way around. But tell us, is it going to help anything?
So you had the House and the Senate both pass their versions, the housing of the 21st century, and the Senate came back with a new road to housing that was a little bit slimmed down, but also included this institutional investment ban that we've already talked about. And they're going to have to reconcile it with the House. The House disagrees with both the institutional investment ban. It also has some other things that were in the House bill that were taken out. So there's going to be this fight, and it's all going to depend on how much the White House wants to sort of lean on the parties to sort of get a deal. No one should expect this is going to dramatically change the game. There's some useful things in there, like how they treat manufactured housing, environmental reviews that are streamlined, but it also takes a while before supply changes make an impact. You have to do it. We have to start somewhere, and we have to start now, but it won't have an impact. That's why a lot of people talk about these short-term fixes to rates or something, hoping to jolt the economy quicker. But if you lower rates without increasing supply, you're just increasing people's ability to bid higher, and that has been shown to be inflationary. So we're finally getting ahead of the game on the supply. On the prices. We don't want to send it back to where it was in the pandemic.
You mean appreciation?
Appreciation going
Oh,
crazy. What was
God,
it?
no.
19% one year. It was insane.
It was,
So.
yeah, it was a disaster,
But when you have
100%.
a 3% mortgage, you can bid a lot, and and only so many homes for sale. So,
I think that what we were what we were talking about before, we have parts of the country where they had lots of land, they had lots, everything was cheap. It's very easy to build there and keep the cost down. When you're in other areas like, where I live, the only way to go is up.
yep,
And people don't want to go up around here. And
yep.
it's not this NIMBY crap. I hate that because just because you don't want to live in a metropolis doesn't make you a not in my backyard jerk. God, I caught that one just in the nick of time. Anyway, so it is, I think that it's going to be different across the country. So a national solution is difficult when everything is so central to wherever you are, right?
Right.
So
I
you can
agree.
have national solutions that don't help anyone at all in certain areas, and maybe they help people who maybe don't need the help as much in other areas.
And I fully agree that supply is a local issue. I would argue, though, that like density is important in certain urban areas. That's the only way you're going to get, supply. But
Yeah, Mark. Yeah.
I
What,
live
what
in
do
a
you
condo. I made
I
that
know.
choice.
Who lives in a condo for 22 years? I mean, for God's
Me. It's very affordable.
Uh, okay, yeah. So we'll just go back and review. I was going to set up a GoFundMe page for you, like what, 2 years ago when you were sweating your tail off in your condo in the middle of
I'm
summer.
on the third floor. Heat rises. It's very
You,
hot.
well, you just don't want to turn on the air conditioning. Let's keep it real, shall we?
The data centers are taking all my energy. What can I do?
Oh, let's talk about that. What was yeah. I mean, not about your energy. You were not paying that air conditioning bill before that. So, what impact do you think that is going to have, those data centers? Are they going to, what are they doing?
I, you know, it's not everywhere in the country, but like Virginia, right next to me, is a big data center place, and they do use tremendous amounts of energy. So, and and they're also reluctant to build them at a, I think many states are now starting to turn on this, and they're charging more for electricity because they're using so much of it. They're basically, it's supply and demand like everything. So, when you have this user in suburban Virginia sucking up all your grid energy, it's going to be expensive for the rest of us who are trying to just keep our houses clean. Cold, sorry,
You're
and
not
clean.
trying to keep your house cold. Maybe warm. I would buy that. Not
Yeah.
clean, not warm, not cold. Anyway, yeah, that'll be an interesting to watch too. So we have an election coming up in November, and all of this has become so political. I mean,
Yeah.
which I hate. I mean, hate. It is mortgages should not be political, yet here we are. So
Yeah.
with that,
Inherently a pragmatist. I agree with that.
something's up with your microphone all of a sudden. It's a little wonky. Um, um, So talk us through the election and what might or might not happen before the election, and what to expect, if anything.
I think we're running out of time. So, like, if there's going to be a housing supply bill, you'll have to see some sort of substantial movement by May. Like, once we get to summer, time is getting very, very short. So, legislative accomplishments will be few and far between, let's say, July and, when they go on recess for electioning, which is like after Labor Day. So, there's only really a couple months left of actual room for activity. And, after the election, who knows? Like, because then you're going to have you could have a divided, where the House is one party, the Senate's another party, the White House is another party. So they're going to have to get together and talk, which seems to be something we're not really good at as a country or a society. But that would be the next phase if one of the houses does flip.
That'd be a massive understatement. We can't talk. Massive, massive.
It does seem to be a problem.
Yeah. So
Anyway.
Greg had made the comment, the data centers have a bigger problem. That's the water to cool them, which,
That's true. He's absolutely right. The
yeah.
water, they suck everything. They suck a lot of water and they suck a lot of juice. So they're and there's a worry that we're oversupplying them. Like they're building them in anticipation of demand. So it'll be interesting to see what the actual demand is.
And what was it? 4% of GDP this year?
Yeah, it's huge.
It's huge. But if you're watching LinkedIn and not expecting to be or wanting to be recruited, then you're seeing the posts that are about AI and its impact and its potential overstatement of what it will bring us and what it will do for our economy. And so it is really going to be interesting to watch this play itself out, because I think it's going to end up being not what they expected or were hoping for.
Yeah, either way, I mean, like either it doesn't do what they promised and that'll send the economy in a tailspin because they've already spent so much money toward it, or it does
Exactly.
what it's promised and we all don't have jobs.
Right. And then you get the back and forth with the economists who are saying, okay, well, it's either going to be a disaster because you've like cut all these people and they no longer have jobs, so they're no longer able to buy anything, and that is going to make, the economy tank, since 70% is consumer spending. And then you have the other people who say, no, no, it's all going to be fine because other than those people, everything else is going to be more affordable and blah, blah. Anyway, so as usual, no one can agree on a single thing, and it's all political for no apparent reason, and I hate it. Um, okay. So, oh God, Guy says we should have all gone nuclear 50 years ago.
Nuclear
I love
power?
my Stepford wife. She's so obedient. Long live AI. Yep, there he is. That's our guy. So anyway, good God. Okay, I thought this was very interesting. So Kevin was, what was he doing? He was renewing something or another, a license, I think. And he sent me a snapshot of the checklist that you had to go through, because on this, you have to answer the following questions: yes or no. Within the 6-year period prior to filing this application, have you ever been convicted of any violation of the law at the misdemeanor or felony level? I mean, misdemeanor. Okay. Are there criminal charges pending against you at this time, or are you currently awaiting judgment and sentencing following entry of a plea or jury verdict? Within the 6-year period prior to filing this application, have you had a denied, suspended, restricted, or revoked business or professional license, including real estate, in California or any other state? Are there any license disciplinary actions pending against a business or professional license you hold at this time? Within the 6-year period prior to filing this application, have you ever been ordered to register as a sex offender? Yeah, that's okay. Within the 6-year period prior to filing this application, have you ever been ordered to cease, desist, and or refrain from doing any acts from violating a law, rule, regulation, da 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 da? Um, okay. So what I thought was interesting is the cease and desist part. I mean, someone can send you a cease and desist letter,
And it might not be based
and it
on,
might not have
yeah,
anything to do with whether or not you're doing something bad, right? So, what do you do with that? And be careful. Don't get cease and desist letters. I
right?
mean,
Because a lot of people issue those all the time, using a name or trademark or anything like that. Yeah.
yeah. So yeah, I just thought that was interesting. All right, let's talk about RESPA for a minute. So, RESPA, try to look more interested, okay, please. Otherwise we think you're about to pass out or you think it's boring. I don't know which. So,
Respect is
RESPA
boring.
always cracks me. It always blows my mind because we teach NMLS, and every single year, RESPA is part of our NMLS training. RESPA has been in effect for 50 years, 50. Yet the blank looks we get from people who seem to not have ever heard of it or know what it means, even though presumably they're taking their NMLS training year after year after year, it's mind-boggling, really, truly mind-boggling. So, just to recap, RESPA, you can't pay to play. Okay, so Mark, take it from there. RESPA, where are we? What could happen? Because there is talk that maybe we'll update this thing.
Yeah, so as you said, it's 50 years old. The idea behind it is, not bad, which is like if you are getting a referral and they're getting paid for that referral and you don't know that, that could lead to bad outcomes. There should be some transparency, in this process where you sort of know if someone's getting paid in order to give you that referral or they have an affiliated relationship or it's their, but I think there is this sense that it hasn't been updated for the times. A lot of sort of what counts as a fee for referral on the internet, especially, it talks about things like desk rentals that don't, even happen anymore. And now we're in this internet age. So I think there is at least a desire to update it. And then a question about like, should there be some other like criteria added? Like, I mean, you should by all means disclose affiliated relationships or referrals, but it's not the goal of RESPA is not to prevent all referrals. That's the way most businesses work is referrals. The goal is to make sure you're not sort of putting the consumer in a worse position based on information they don't know about your relationship with that referral party. So I think if we stuck to core principles, there could be a way to make this work better. But I think it's something where we're going to need everybody to jump in the boat and add their feedback as to what should change. What it is it's a law, so the bureau can't waive this away. It's in that 1974 act, but the bureau can issue clarifying regulations that perhaps, you know, especially the bureau has been tied in knots over this. Like at one point, Richard Cordray added it's like basically said almost any referral in any relationship is wrong, and that went too far. That was the PHH case we just talked about. PHH that led to the Supreme Court ruling against him. So I think this the NBA has called for RESPA reform. I think a lot of people are interested in doing something in this space. It is a very complicated, thing to do. Like, how do you change it and sort of update a 50-year-old law? But I think if we all work together, maybe we could find things that make perfect sense. And I'm perfectly willing to take any ideas anybody has and feed them into the NBA and others who are working on this.
The NBA AI chatbot, you can just
The
feed all the
NBA AI
ideas in
chapter.
there. They can spit out a law, shoot that over the CFPB, see if we can get a rubber stamp and get that thing through Congress. Is that how we do it?
Well, Congress seems harder. I think your best bet is having the Bureau issue some sort of clarifying or improving regulations, but you need the Bureau to be around. As you know, they're still tied up in this limbo zombie lawsuit that has been over their heads for the past year plus now. It's been a year since I left the Bureau, so they've been under this limbo for one full year. And you need an active bureau to be able to change things like RESPA if the industry believes there's changes are needed. And same thing with LO Comp and other things that I've heard time and time again.
Yeah. So, okay, I still am a little unclear. So it is a law that Congress passed. Yes.
Yep. Yes.
But to change said law, Congress is not going to write it up like they did Dodd-Frank. They're going to depend on a regulatory agency like the CFPB to put it together, and then they come
The
into the
way most
picture.
laws work is like you basically say you shall not do X, or you fees for hurl are generally bad, and then you designate an agency to say you shall provide the detailed guidance in order to implement this. The CFPB, it used to be HUD, is the one for RESPA. So they've been designated. It was originally HUD, and now it's CFPB, and they issue clarifying guidance. Like they just issued all those FAQs before I left, about what you can and can't do, and clarifying housing counseling and other things. So that's the way almost most federal things work. Congress says X, like that LO comp thing is in Dodd Frank, and then it says this agency is in charge of issuing rules, guidances, and can change it if they need to reflect market.
So if some, I mean, who knows with the CFPB? So if they were no longer here, would that go back to HUD then, do you suppose?
That if they got rid of, by the way, there's no way to get rid of CPB without Congress acting. If
Right.
Congress did that, then yes, they'd have to designate an agency to take all the authorities. There's something like 20 different laws that have some authority that goes to the Bureau. So that law saying the CPB no longer exists would have to say, here's the agency that gets all the, this RESPA goes to HUD, this will go to the Federal Reserve, this will go to that. It would be a very complicated undertaking, obviously, to unwind something that's been around now for what, 17 years, 16 years, something like that.
Yeah, a while. Boy, that was a thrill when that rolled out, I got to tell you.
No, it
Uh,
was a nightmare. I mean, it was hard to do both doing it, moving, because what it did is it took a lot of authorities from all over the place and put it in one agency under the thought that that would be, you know, you'd have one rule-making body that covered all these consumer laws. You'd have control both non-banks and banks and credit unions. You'd have one regulator that covered the waterfront. But to unwind it would be equally complicated, I would imagine.
yeah, I would think so too. And we've come such a long way because we went from, we were the devil and the CFPB was put into place to protect the consumer from us specifically. I mean, I literally heard guys say that from the CFPB. They were taking a paternal role, a paternal role. I just, oh God, I was so pissed when I heard that. Anyway, we've come from that to, you who has a real broad understanding of the market, who really does see both sides. I did have to set you straight on the whole, go shop the shit out of a rate. But, you came around sort of, at least, when I'm in front of you so that you don't get put in time out again. But anyway, I mean, we've come so far and I feel like there have been such good things that have come out of it. And yeah, I just,
Yeah, I always thought the idea is not to like get rid of these agencies, but to make them better and to
yes,
make sure that they take feedback from people like you and all your listeners who know how the market actually works.
yep,
Part of the problem with DC is a lot of us, haven't been in more, there are people at the Bureau who know mortgage, but maybe they were in mortgage 10 years ago, or 15 years ago. And we need that constant feedback loop from both industry and consumer
yep.
advocates to make sure we understand what's really happening to your customers and consumers all over the country. And they will that's the only way you get regs right is to have that feedback all the time.
Yeah. Yes, I agree, 100%. And it is troubling to see us, take steps forward and then take, like somersault backwards to so that's why I'd like to see the politics get out of mortgage. I don't know how that will ever happen. And again, it is not one side or the other that's better at this because both sides, in my opinion, just my opinion, are terrible. Like they come in, they've got an agenda, and then that's why the pendulum is constantly swinging for us and the borrowers. And all we want to do is help our people
Yeah, most of
achieve
us are in the
homeownership.
middle who we just want to be able to buy a house, get a
Yes,
mortgage, be able to pay the
yes,
bills, have
yes.
some sort of that we don't really care about the more ideological aspects of it.
Ugh, God. Yeah. Anyway, so there you are. It has been another wild week. I don't expect for it to be, calm, cool, and collected anytime soon. And so we just hang in there. And if you see a rate you like, lock it in. Oh
Yeah,
God.
someone said, marry the house, date the rate. There you
Oh my
go.
God, don't get me started on that. And then he said, but he also said divorce the or he said divorce the debt. Jeez Louise. And he was talking about discretionary income, which is
Oh,
important.
that's a good
So
idea, though. Yeah, that was
yeah,
good.
so look at discretionary income. How much do you have to spend every month? It's not,
Cash flow. I love cash flow, as you know.
yes, exactly. And so many studies have shown that DTI is just not the driver or the
Nope.
indicator of anything, bad. So,
You
but
need
the whole
S
date the rate
spending.
thing, I think it's misrepresented big time because it's promising somebody to refinance that may or may not ever happen.
For
And
sure,
that's what
true.
I don't ever want to do. So, anyway, oh, Cheryl, thanks. She says, I love your ditty. I sing it all the time. All right, kiddies. Well, it is. Thank you so much for being here, Mark. I feel it doesn't feel right without Kevin. So I really appreciate having somebody who, I love, who is here with me. And even though your, brain is going to shrivel up and die because you stopped learning 11 languages, it's fine. I appreciate your taking this time for us. So,
De nada.
with all of that, everyone, there are deals out there. People are buying houses. Refinances are up big time, big time. And so are purchases, by the way. So get out there, go get a loan, close a loan, no complaining, no waiting for the rates to come down. And we will see you next week.